The six accounting assertions are occurrence or existence, completeness, accuracy or valuation, cutoff, classification or understandability, and rights and obligations. Occurrence and existence is when assets, liabilities, and equity all have balances at the end of the accounting period. Completeness is when all transactions, balances, events, and other matters that should have been disclosed are disclosed in the financial statements. Accuracy or valuation is transactions, events, balances, and other financial matters that have been disclosed accurately at their appropriate amounts. Cutoff is transactions have been recognized in the correct accounting periods. Classification or understandability is transactions have been classified appropriately and presented clearly in the financial statements. Rights and obligations is when the entity has the right to ownership or use of the recognized assets, and the liabilities recognized in the financial statements represent the obligations of the entity. The six-step audit process involves 6 steps, being plan the engagement, use a top-down approach, test the controls, evaluate identified deficiencies, a wrap-up, and a report on internal control. Planning the engagement is when you consider the knowledge of the industry and the business, as well as the extent of changes in operation and internal control. And then you evaluate controls for all relevant assertions. Using a top-down approach means to identify entity-level controls, perform walkthroughs, and have an auditor that must perform work related to company-wide anti-fraud programs and controls that have a pervasive effect. And you also must obtain principal evidence for opinion on their own. To test controls, a sample of transactions is examined using inquiry and observation, inspection, and reperformance. Test of controls would not be performed if design is not evaluated as effective. To evaluate the identified deficiencies, you would categorize the deficiency as design or operating, and the more significant deficiencies that are found are categorized as significant or material weaknesses. In order to have a wrap-up, you issue one of 3 opinions, the first one being an unqualified opinion, meaning no material weakness was found. The second one being a disclaimer of opinion, meaning that the audit team cannot perform all of the procedures. And then there's a third one called an adverse opinion, which means there are 1 or more material weaknesses that were found. The 6th step is to have a report on internal control, which includes the auditor's opinion on internal control effectiveness and the fairness of the company's financial statements.